Welcome back. Today we are going to address a question that many people have begun asking quietly, even if they are not yet comfortable saying it openly. Could XRP be one of the strongest investment opportunities heading into 2026? Not next week, not tomorrow, and not because of a sudden headline-driven spike, but as a calculated position taken with a full market cycle in mind. Before assumptions are made, this discussion is not about hype, exaggerated price targets, or unrealistic projections. It is about whether XRP, based on its current positioning, is structurally stronger than most people recognize. XRP remains one of the most misunderstood assets in the crypto market. For years, it was rarely judged on fundamentals. Instead, it was filtered through lawsuits, misinformation, tribal debates, media noise, and surface-level comparisons that missed its actual purpose. Many dismissed it not after deep analysis, but because following the majority opinion was easier. That matters because markets often reward assets only after the crowd has already written them off. What separates the current moment from the past is that this is no longer theoretical. One of the largest uncertainties surrounding XRP for nearly 5 years has now been removed. The regulatory conflict that defined its narrative is resolved. Regardless of opinions about Ripple, regulatory clarity is critical. Markets punish uncertainty aggressively, and once that uncertainty is removed, the risk profile of an asset fundamentally changes. For the first time in years, XRP can be assessed as an actual asset rather than a legal liability. That alone does not make it a good investment, but it removes one of the primary reasons institutions, funds, and large allocators avoided it. That change is subtle but meaningful. Capital does not flood in instantly. It returns cautiously, structurally, and over time. Another commonly misunderstood factor is how institutions actually operate. They do not care about online debates or social media narratives. They focus on compliance, liquidity, scalability, and whether an asset fits into existing financial systems without destabilizing risk frameworks. When crypto is evaluated through that lens, the list of viable assets becomes very small. Outside of Bitcoin and Ethereum, few networks qualify. This is where XRP begins to stand apart, not because it is flawless, but because it was designed with a specific function from the start. Cross-border settlement, liquidity bridging, and financial system integration have always been core to XRP's architecture. These were not narratives invented last cycle. What has changed is that the regulatory and institutional environment is finally aligning with that original design. Timing is also crucial to understand. This is not a euphoric market chasing any available ticker. It is a market that has been burned, reset, and forced to mature. That type of environment favors durability over hype, infrastructure over speculation, and resilience over attention. Looking specifically toward 2026 matters because it allows time for structural shifts to take effect. ETFs do not rewire markets instantly. Institutional partnerships do not change liquidity overnight. Regulatory clarity does not immediately reprice assets. These forces move slowly, but when they compound, they matter far more than short-term price movements. A common mistake people make is assuming that if an asset has not already surged, it must be irrelevant. That is lazy thinking. Historically, some of the strongest performers are assets that spent years being ignored while infrastructure quietly developed beneath the surface. When perception finally shifts, much of the repricing is already underway. None of this guarantees XRP's success. There are legitimate risks, competition, and timelines that could stretch longer than expected. However, dismissing XRP outright in 2025 or 2026 without examining the evidence is no longer an informed stance. It is an emotional one. This video is not about selling dreams. It is about examining real catalysts, structural changes, and why serious investors are beginning to reassess XRP as a long-term position. Not because of extreme price claims, but because the surrounding environment has fundamentally changed. To understand why the narrative around XRP has shifted so dramatically, regulation must be addressed first. Not headlines, not opinions, but resolution. For years, the SEC case was not just a lawsuit. It was a structural barrier. It froze institutional interests, discouraged custodians, blocked ETF discussions, and left XRP in a legal gray zone that serious capital avoids. Institutions do not speculate around unresolved regulatory exposure. They wait. That is exactly what happened. When the Ripple SEC case concluded in August 2025, it did more than close a chapter. It removed one of the largest overhangs any major crypto asset has faced. Ripple agreed to a defined settlement. Appeals were withdrawn. For the first time in years, XRP gained legal clarity in the United States. That matters more than many realize. Markets dislike uncertainty, but they especially reject open-ended uncertainty. Once that risk was capped and quantified, XRP's profile changed immediately, even if price did not respond right away. Retail often misunderstands this. Price does not instantly react to positive developments in institutional markets. Regulatory clarity unlocks processes, not pumps. Custodians can list assets. Funds can model exposure. Banks can integrate. ETF issuers can file. These actions reshape long-term demand rather than short-term charts. This connects directly to the ETF discussion, which is widely misunderstood. XRP-related ETFs and structured products have already seen meaningful inflows, much of it occurring quietly through OTC accumulation and long-duration vehicles. The common question, why price has not surged, misses the point. This capital is positioning, not speculating. The Vanguard policy shift in December 2025 illustrates this change. Vanguard did not simply allow crypto exposure, it reversed a long-standing stance and opened access to crypto ETFs, including XRP-based products, for tens of millions of clients. That is institutional distribution. When distribution evolves, markets evolve, even if the impact takes time. These ETFs are designed for long-term allocation, pension exposure, and portfolio balance. They do not churn weekly. They accumulate steadily, rebalance slowly, and reduce circulating supply without generating volatility. That is why ETF inflows do not resemble hype-driven buying. Dismissing ETFs because price has not reacted is a mistake. ETFs normalize exposure rather than create excitement. Once an asset becomes embedded in traditional portfolios, its liquidity structure and demand base change gradually. Regulatory clarity combined with ETF access is not flashy, but it is foundational. It does not guarantee upside, but it significantly reduces downside risk compared to previous cycles. For long-term investors, risk reduction is as important as upside. XRP has crossed a threshold many projects never reach. It endured regulatory scrutiny and emerged with a clearer path forward. Adoption and supply dynamics further reinforce this shift. Regulation clears pathways, but adoption drives sustained relevance. What is happening with XRP is not loud retail speculation. It is quiet institutional integration. Payment and settlement usage is increasing, moving XRP beyond a pure trading asset. Partnerships involving MasterCard, WeBank, and Gemini highlight this shift. These are not marketing headlines. They are infrastructure decisions. The use of Ripple's RLSD stablecoin on the XRP ledger for real settlement expands XRP's role as liquidity plumbing. Long-term demand grows from repeatable usage, not narratives. Stablecoins do not replace XRP. They depend on it. They require neutral settlement and liquidity bridges. As stablecoin activity increases, the importance of the underlying liquidity layer grows. Accumulation patterns further support this. Ripple-affiliated entities accumulating large XRP positions through open market activity is strategic, not accidental. Large players accumulate assets they expect to matter. Over time, this alters supply dynamics. XRP increasingly moves into long-term holdings, corporate treasuries, and infrastructure use, reducing freely circulating supply. Ripple's acquisition of Metaco and treasury-focused expansions add another layer. These moves are about embedding crypto into enterprise finance. When infrastructure integrates, it persists. XRP's audience is shifting from retail speculation toward institutional reliability. Infrastructure often appears boring until it becomes indispensable. Adoption does not always announce itself. Sometimes it whispers. When partnerships, accumulation, and supply positioning align, it deserves attention. These developments also align with broader macro shifts. Global finance is being pressured to modernize settlement systems. Banks, clearinghouses, and custodians need efficiency, transparency, and cross-border capability. This is not a crypto problem. It is a financial system problem. XRP's design fits this environment. It was built to move value between systems, not to be a meme asset. As financial complexity increases, neutral settlement becomes more valuable. Ripple's deeper integration with DTCC-linked infrastructure through Ripple Prime reinforces this trajectory. Multi-chain expansion increases the need for reliable settlement layers rather than diminishing it. Geopolitical shifts, de-dollarization discussions, and alternative payment corridors further highlight the relevance of neutral liquidity assets. 2026 allows time for these forces to compound. None of this guarantees outperformance. Competition remains, execution matters, and timelines vary. But XRP is positioned in a segment likely to matter more over time. The real question is not whether XRP will pump next, but whether assets built for real financial integration will be valued accordingly. XRP today carries a different risk profile than in past cycles. Regulatory clarity, institutional access, real-world integration, evolving supply dynamics, and macro alignment all shift probabilities. That does not remove volatility or risk, it reframes them. XRP is not inevitable, and certainty does not exist. Markets reward patience informed by evidence, not blind conviction. XRP's appeal lies in alignment, not hype. When regulation, infrastructure, institutional behavior, and macro direction align, assets tend to reprice in phases. Long stagnation often precedes recognition. Dismissing XRP outright is as flawed as blindly promoting it. Serious investors weigh evidence, assess risk, and decide alignment with their strategy. XRP may not suit everyone, but ignoring its developments ignores reality. Looking toward 2026 requires shifting focus from noise to structure, from chasing the next pump to identifying what remains relevant across cycles. Assets that survive scrutiny, integrate with legacy finance, and solve real problems tend to endure. Everything discussed here is for educational and informational purposes only. This is not financial advice. No instruction is given to buy, sell, or hold any asset. You are responsible for your own research, risk management, and decisions. Crypto involves risk, and nothing is guaranteed. Always do your own research and invest responsibly.